All right, so we are in the middle of the year, and if you are one of those who are planning to switch jobs for a higher salary and better prospects, then beware, there are certain tax pitfalls that you should be aware of in order to avoid big tax blows. What are the things you should be careful about as you move to a higher tax bracket? To discuss all of this, we have on board Arvind Rao, CFP and CA founder, Arvind Rao Associates. Arvind, good evening. Welcome to the show. First of all, if you are changing a job, obviously for a higher salary and a better position, what are the things that you need to wind up with your previous employer?
Hi, Kavita. I think nothing much there when you're leaving the old organization, because I think as a part of the exit formalities, most of the things are covered by the outgoing organization. I think the only major thing from a decision point that comes in is regarding the if the employee was a subscriber of PF in the organization, then what needs to be done with the outstanding balance in their PF account with this organization. If they are joining whichever new organization that they're joining, if they too are covered under PF, so obviously the employee has a choice to transfer their balance from the old company and shift it to the new company so that all the benefits on the PF can continue. However, if any employee has now been bitten by the entrepreneurial bug and has decided to go and have a new startup done, in which case I think the choice for them would be to opt to withdraw that PF.
Okay. Interesting. Let's talk about the exemption limit because this is supposed to be a huge tax pitfall if at all you have a double counting done for that. What is this double counting of tax exemption with your previous employer and the new employer that one should avoid, and how can we do it?
So yeah, I mean, I'm sure our viewers here must be wondering about what exactly is this double counting that you are referring to.
Exactly, yeah.
So let me simplify it for them. So I'm sure within our viewers there are some who would have given like this SOS call in particularly July of a year, because July is the year when you are doing the tax filings, and they suddenly find out that they have to shell out a huge amount of sum towards taxes, and this invariably coincides with the career move that they did in the previous year. Okay. So let me tell you what happens here is that, let's say an individual is employed with company A and has spent around 5 months of this year in this company and later moves on to company B at a higher salary. I think, Kavita, including you, most of us are aware that at the beginning of every financial year, we make certain declarations to our employer.
Yeah.
Namely, what are the savings in terms of tax investments that they're going to do. And in the last couple of years, a new thing is which regime they would opt for, whether it's the old or new. Now, based on these declarations, the employer factors in the salary due for the year, makes all the tax calculations and starts deducting tax every month from the salary. Now, while doing this, obviously the employer factors in the typical ATC deduction or the home loan interest deductions, and the employee's salary writes the tax slabs, by which I mean that 0 to 2.5 lakh of rupees, there is no tax. On the income between 2.5 to 5 lakh, you pay a 5%, above 520, and above 10 is 30%. So this is all good as long as you are within the same organization.
Okay.
Now, the moment you flip to the new one, obviously, as a part of the negotiation, normally an employee discloses what salary they were drawing in the previous organization. But Kavita, here is where the slippage generally happens. That although the new employer knows what the salary was, when it comes to that part where the new employer's finance or the HR team is doing the tax deductions, they're supposed to factor in this salary from the previous organization as well and calculate what is the tax due when you add both these salaries together.
Okay.
So what exactly is this double counting here is that in case this doesn't happen, so what happens is these deductions that we spoke of, as well as these slabs of 0 to 2.5 nil rate and all those things, they are mirrored in company A as well as company B.
Right.
And finally, at the point of filing the tax return, when the individual cumulates both these salaries, the way it has to be is that these deductions are available only once. Like we discussed earlier, the table that has been shared clearly shows that at even smaller salary levels, like if a person is moving from a 1.25 lakh salary per month to around 1.5 lakh salary a month. Although the jump seems normal, but the tax liability because of this double counting that may happen could be close to more than 1 lakh plus interest on this delayed payment of taxes that an employee may have to pay. And believe me, although this tax amount is not an additional tax, it's the same tax which the person would have paid otherwise.
Right.
But when it comes for payment at the end of the year, it really pinches the employee very hard.
Totally. Yeah. So how can we avoid it? How can we make sure that it's not doubly counted, Arvind?
Two things. Number one is obviously there is a joy of having shifted the company. So that means you have moved at a salary hike, your in hand will be slightly higher. But if you have moved and in the first couple of months you find that your in hand is much more than the hike you negotiated for, then I think that's the first word of caution there. They need to go back to their finance to check on what basis have they calculated the taxes and ensure that whatever was the gross salary as shown in the full and final settlement letter, the salary amount as well as the taxes that have been paid on that have been calculated and factored in the new organization.
All right. So now after this being done, there are a couple of things that we need to pick up from our previous organization. Certain forms, Form 16, obviously you get in the later part of the year. But then if talking about Form 12B, Arvind, what is the importance of this form and how important it is for you to take this up?
So 12B is a form which essentially the new organization may ask in terms of, that's the form where the salary or income details from the previous organizations are picked. So 12B basically shows the breakup of the taxes and what kind of deductions have been factored in by the old employer and whatever are the taxes due and deducted by the old employer are the ones that is available there, which has to be collected and duly submitted to the new company.
So Arvind, what is the difference between a Form 16 and a Form 12B, which is more important and relevant then?
Well, both have their own significance because Form 16 is the final certificate, as it is called. It's basically a certificate of taxes deducted by an employer from an employee's salary. And that becomes the basis on which the returns are filed. Form 12B is more of an interim document that highlights the breakup of income and the taxes paid on the same.
One question that I missed asking you while discussing the declaration part, what if an employee has opted for an old tax regime and in the new organization wants to go for a new one or vice versa? Can we settle this change? Will this impact our tax structure?
That's an interesting question. Now, I think it is possible for the regimes to be different between the two employers. The reason being that irrespective of whatever regime an employee might have declared or requested the organization to put him or her into, at the point of filing of return, the employee still has a choice to decide which regime to go for and can change that even then.
Okay.
So, in my view, I think the flexibility to change the regimes will exist when they switch.
Could you please explain both the tax regimes in a slightly detailed manner?
Okay. So, a couple of years back, all the taxpayers were now given an option to opt for either to continue with the old regime or old regime is basically the way taxes were calculated over the last number of years, which is You take the gross income, you take deductions like ATC or the Mediclaim or the home loan interest deduction. You net off all of that and you pay tax on the balance as per the slabs which I mentioned in my previous example. And 2 years back came this concept of new regime, wherein a taxpayer could opt to forego all of the deductions, or rather, instead of forego, I think not claim any of these deductions. And as a trade-off, what happens there is the slabs are changed. So normally above 5 lakhs in the old regime, the slab directly jumps to 20%. Whereas in the new regime, the slab would move to 7.5% for 5 to 7.5 lakhs. 7.5 lakh to 10 lakh would be 10%, 10 to 12.5, 15%, and so on. So basically, the slabs expand in the new regime slightly slower, as in you don't directly land up at paying 30% tax above 10 lakhs. You get you get a more breathing space there. But of course, that comes at the cost of not claiming any deductions, whether it is the PPF or the Provident Fund, insurance, any of these are not permissible under the new regime.
Now, for example, an employee is going to a new organization. If you have a new job, you're joining mid-year. I want you to explain us, how do we look at the salary breakup, and how do we understand for example, if the new organization has have a new way of counting your HRA, what if you have a variable pay element in that? How will that impact and change your tax structure, Arvind?
Okay, so I think point number one, independent of whichever organization an employee joins, the way the exemptions or deductions are calculated will remain the same, because the Income Tax Act is the same. So as long as the declaration in terms of the rent that a person is paying remains the same, the way the HRA exemption will be calculated will remain the same. Although the exemption could vary, because depending upon the breakup of salary. So if in the new organization, if the HRA allowance is slightly more than it was in the previous organization, there is a possibility that the exemption for HRA could be higher. That's one. And there was another question you squeezed in, right, Kavita? Sorry.
Variable pay.
Variable pay. So I think the way variable pay is taxed, there is absolutely no change. And I think the only thing that the introduction of variable pay as a component in the new organization salary, the implication for that is that your in hand, normally, I think when you're negotiating a package, you are always talking in terms of a CTC, or the cost to company as it expands. And a variable pay as a part of that CTC, it implies that your monthly take home will not be equal to your CTC divided by 12, because this variable pay is something that will accrue to you and will be paid out either at the end of the year or maybe once in 6 months, depending upon the policy of the organization. Otherwise, the taxation of the variable pay is quite straightforward. It is directly taxable as per the slab rates.
Which are the other tax flows that we should be careful about when joining a new organization, Arvind?
Which are the tax rules?
Tax blows or pitfalls.
So I think the other thing I'd like to point out here is about being careful about the transfer of PF, because for those employees who have been working for less than 5 years and are moving organization, they need to know that due to oversight or due to any unintentional reason, if they happen to forget to transfer the PF and they go to withdraw, then for PFs or Provident Fund accounts which are in existence for less than 5 years, any amount that is withdrawn from that will be taxable in the hands of the employee. So I think one of the reasons Provident Fund is so valuable and most sought after is because of its tax-free status. So in order to retain this, it is important for the employee to ensure that they transfer this balance, specifically if the tenure of working is less than 5. If it is more than 5, they will not be impacted by the tax on it because it will be tax free for them. But yes, it will be difficult for them to redeploy this money at the tax free rate that is available under the PF Act.
How easy or cumbersome is this PF transfer? How do you do it? Just do it online? Any specific forms that we need to fill?
I think it is handled by the organization itself. So all you do is inform the new organization that this is my old details and they'll help with the transfer.
All right. Yeah. All right, Arvind, thank you so much for joining in and explaining all the taxation rules if at all you're joining a new organization, how to stay away from big tax blows.